Sure. The external financing requirement is very large. In absolute terms, it's about $215 billion this year. I think more importantly, as a percentage of foreign exchange reserves, it's around 200% of foreign exchange reserves. So it's large, as you say. It's a perennial issue. But it's also one that Turkey has navigated in the past. It's gone through a significant number of stress tests and has been able to roll over has been able to deal with this large external financing requirement. We can certainly see a number of mitigants. If you break down the $215 billion, you've got around $45 billion as the current account deficit, out of which, $10 billion is FDI. In terms of the banking sector, it's about $100 billion of rollovers, and in terms of non-bank private sector, it's about $60 billion. So for the banking sector, we know that of this $100 billion, about $50 billion is actually pretty stable financing. It would come largely from parents, or it would come from IFIs. We also know that the banks have about $60 billion in the ROM and in other facilities at the Turkish central bank, i.e. this is money that banks, again, will have access to. Also, we think that banks have about $35 billion in swaps, in FX swaps. So we think the banks can manage, if they were shut out of the markets for a year, we think the banks have access to sufficient FX to manage that. In terms of the non-bank private sector, again, the bulk of the exposure is by corporates that have a hedge in one form or another. So either a natural hedge in terms of FX revenues, or they actually hedge themselves. And we rate a number of big Turkish corporates. We know they've got fairly sophisticated hedging. There is still a gap there. The corporate side is where we don't necessarily see the full coverage of this FX exposure. But the central bank has taken a couple of moves in the last few months that we think are positive in this regard. One was the introduction of non-deliverable forwards in November. The other was a clampdown on non-bank private sector access to FX, which was certain measures were announced in January. These will be put in place in May. And we know that the central bank is looking at this in more detail. We're expecting more macroprudential measures by the end of the year. So the mitigants are there. I think the risks would just be a combination of events. It would take another political shock, but a political shock in the context of a broader deterioration in financial conditions to test these stresses again for Turkey.